Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities to make really good money, but also protecting the downside when we think we need to. I hate to lose money. So my investment philosophy, loss averse investing, this is something my firm invented many, many years ago. And along the way, I've really improved the processes. And I think we have a really compelling approach to managing money. So maybe as much as 10 years ago, I developed a technical algorithm that uses technical analysis. It just simply uses moving averages. So when a market's going up, you go with it. When a market's going down, you protect your portfolios. So either a stock portfolio that you're invested in growth or value, or an ETF portfolio where you may have the S&P 500 or the NASDAQ, we can protect the downside when the market rolls over. So the big picture of loss averse investing is just simply protecting that downside when the markets are falling and allow your portfolio to run when the markets are going up. So looking into 2024, we think that there's likely a recession that's brewing. Maybe it doesn't happen, but if it does, that generally spells for a bear market. Bear markets can decline 20 to as much as over 50%, or markets can go sideways and be volatile over a very long period of time. So basically make no money unless you're buying low and selling high. So how my philosophy works is it's kind of like a dimmer switch. So I use 3 moving averages. So as you break the initial moving average, you get a little defensive. If you break the second one, you get more defensive. You break the third one, you lock your portfolio down. It's like being in cash, but you're just protecting the portfolio, allowing those long-term gains to build up, so not taking the tax hit on the core of your portfolio. So assuming a perfect world, and the world's not perfect, but assuming a perfect world where you could buy at the bottom, sell at the top. So if you go back to the beginning of 1997 and you bought the markets, bought the S&P 500, and then you sold at the high, you did this 8 times until September 2023. So roughly a 26-year period. In a perfect world, your $1 million portfolio would have turned into $53 million. Now, a buy and hold approach is buying the S&P 500 and going through, the roller coaster ride along the way, you would have turned into $5.6 million. So that's not bad. That's a pretty good return, but it pales against avoiding the downside in the markets. So we all know there's no perfect way of doing this. There's frictional cost. So to get those types of returns, I have a strategy. I have 3 tactical strategies, but the strategy that's more aggressive to protect the downside and to get those type of returns, it's called tactical core. So tactical core is more aggressive on the upside than the markets, and then you still have, the way I manage it, you still have downside protection. So we have 3 tactical strategies. We have dynamic core, which is just the S&P 500. We have tactical total return, which is the most conservative of the 3. And it's very well diversified, a nice conservative portfolio, protects the downside really well, goes up when the market goes up, but not to the extent as tactical core. Tactical core has a much higher beta, goes up much more aggressively on the upside, but now, since I manage it, protects the downside as well. So if you look at this cartoon, this is our middle strategy. So this is dynamic core. This is just the S&P 500. So when the S&P 500 is going up, you're going to get just the returns of the S&P 500. No better, generally no worse, but no better than the S&P 500. So as long as the S&P 500 is going up, you stay with it. So the green line is the market, and the black line is the portfolio, and the dotted line is the 200-day. For lack of a better way to illustrate this to you. Now remember, I use 3 different moving averages. So as you break through that key moving average, you're perfectly hedged up. So you have 2 S&P ETFs in the portfolio, and then another inverse ETF of the S&P 500 that protects the other two. And then as it falls, the market falls, you go sideways. Your portfolio is going sideways. And as the market turns back up, crosses positively over those 3 different moving averages, so you incrementally get back invested along the way. You have nice returns when the market's going up. So it looks like you're compounding at a much higher rate than the markets on the upside, but you're not. You're just starting at a level, when the market started to fall. So you're compounding at a higher level versus being kind of where you started when the market cycle started in the previous cycle. So capturing this big upside is what we want to do. Going sideways again in another bear market, you can see the distance, how much more you would have made just by being defensive when the market falls. So I want to walk you through the real world. Okay, this is the S&P 500 from 1997 forward. So the beginning of 97. So the market goes up 106% into the year 2000. So then it falls by 49%, and then it goes up by 100%. So in that period of time, when it fell again into 2008, over that roughly 12-year period, you made 0 money on your buy and hold strategy. I know the big firms, the big wirehouses tell you buy and hold because they want to keep your money there, right? Well, there's a better way of doing it, much better way of doing it, and it's more defensive, it's more conservative. So as you would have, if you would have invested in a perfect world, the way I described it to you, if you're up 100%, you go sideways to the bear market, then the market goes up another 100%, right? So you go from 1,500 on the S&P 500, then you'd go to 3,000 on the S&P 500 in 2007, instead of being at only 1,500. And then when the market broke, went back down to roughly 700, you're still at 3,000 and then moving higher. So you can see how that $1 million portfolio turns into $56 million by simply being aggressive. So this is a cartoon of how we do it. It's not the real world. In the real world, there's frictional costs. You may get some false signals along the way. You have to react to them. Like there's signals here. We think we can actually improve the performance with our 3 different moving averages, slowly getting out and then getting back in at a low level. So we think we can actually improve upon what we described to you. But to make sure we're getting those types of returns, we take a more aggressive portfolio. And so instead of having equal with the market on the upside, we're getting, say, 1.3 or 1.4, or maybe even as high as 1.5 times what the market's doing on the upside, but protecting it really aggressively when the market falls. So this is the overall philosophy that I have. I generally like to have some money in conservative loss-averse strategies and then some money in more aggressive strategies, but hopefully getting a double-digit to maybe high double-digit, 15 to 20% type of returns over an extended period of time to get really strong absolute returns over time that should blow away a buy and hold approach. I describe buy and hold as much more risky than what we do being loss averse. So if you're interested in this, please go to my website, Patrick Adams CFA, send me an email, ask me some questions, or set up a call. I'm happy to do a call with you. So please hit like, subscribe to the channel, watch Market in a Minute every week, and we will likely talk about when we're changing our strategies in that piece. Thank you very much.